Most Americans think danger arrives with a warning, a layoff email, a market crash, a bill they can't pay. But the real damage always starts smaller. A gas price that feels a little higher, a grocery receipt that suddenly looks strange, a credit card minimum that quietly moved up. Nothing dramatic. Not yet. The system never hits you all at once. It leaks pressure first. That's why most people miss the moment that actually matters. Not the collapse. The signal before the collapse. And right now, that signal is already here. People still feel calm because their brain keeps labeling it as temporary. A weird month, a rough quarter, a little inflation, some market noise. But Rex knows this pattern. He's seen it in 2008, 2020, and the 2022 inflation. Mortgage resets, car loan traps, grocery waves, and layoffs after tech booms. The pain always starts as something ignorable. Then, suddenly, it becomes the whole story. By the time it feels real, the maze already closed behind you. And the next signal is the one almost every American ignores, until it empties the checking account. The first place the future shows up is not the stock market. It's your checking account. Not because something huge happened, because small leaks stopped being small. A little more at the pump. A slightly bigger grocery bill. One more subscription renewal. Insurance creeping up. Utilities moving just enough to feel annoying. That's how the trap works. Nothing here looks like a crisis by itself. But together, it becomes pressure. People don't notice when they're getting poorer. They notice when breathing gets expensive. That's the checking account lie. Americans keep looking at income and thinking, I still make good money. But the real number isn't income. It's what survives after invisible bills finish feeding. This is where the middle class gets trapped. The salary still looks healthy. The lifestyle still looks normal. The bank app still says there's money. But less and less of it belongs to future you. More of it is already promised to debt, subscriptions, fuel, food inflation, and insurance. The account looks full because your obligations haven't all cleared yet. People mistake temporary balance for real stability, and when the next wave arrives, that illusion breaks fast. The next thing coming isn't higher prices. It's delayed pain most Americans mistake for safety. The most dangerous financial problems never hit immediately. That's why people stay calm. The system gives you a delay window, a false sense of safety. Today, the grocery bill is only a little worse. The car payment still fits. The credit card still clears minimums. The emergency fund feels untouched. So the brain whispers, we're okay. But Rex knows this is where the maze gets cruel. The bill you're scared of next month is usually created this month. That's delayed pain. It starts in places Americans don't track. Diesel costs, insurance repricing, interest resets, and utility rate adjustments. Nothing explodes overnight. That's why people do nothing. They confuse delay with danger disappearing. Huge mistake. Because while your mind feels safe, the system is already rewriting. Food prices, travel prices, loan math, and household margins. The danger isn't gone. It's just traveling through the system. This is exactly why families wake up one random month feeling like everything suddenly costs more. It didn't happen suddenly. It was building quietly. And once delayed pain finally reaches the checking account, people start making emotional decisions. That's where the real losses begin. And the next trap is why smart Americans still make terrible money decisions under pressure. Money problems rarely destroy people first. Pressure does. The moment bills start feeling tighter, something changes inside the nervous system. You stop thinking long-term. You stop optimizing. You start reacting. That's when smart Americans begin making decisions that only make sense inside fear. Bad money decisions usually start as good stress decisions. That's why people under pressure suddenly do things like pause retirement contributions or carry higher balances. They finance convenience purchases, sell investments too early, delay maintenance, or trade a paid-off car for a lower monthly payment illusion. It feels logical, because the brain switches from wealth mode to survival mode. And survival mode only wants one thing: less pain right now. It does not care about future compounding, long-term optionality, interest drag, or hidden fees. It only wants immediate relief. The system doesn't need you to be bad with money. It only needs you to be scared with money. That's why even disciplined people get trapped. Fear compresses time. Next year disappears. 5 years disappears. The only thing that feels real is this week's pressure. Once millions of households start making short-term fear moves, the economy starts slowing. That's when layoffs, defaults, and spending freezes begin multiplying. The next signal is where Americans accidentally build tomorrow's crisis, trying to survive today. This is where the maze becomes invisible. People start solving today with tomorrow's money. At first, it feels smart. Move the balance, stretch the payment, refinance the card, take the promo. The most dangerous debt is the one that feels like breathing room. That's the trap. Americans call it flexibility or cash flow management, but it is really pressure moved forward with interest attached. This is how a family making 6 figures still ends up paycheck to paycheck. Not because income disappeared, because pressure kept getting rolled into the future until the future became impossible. Like carrying rotating credit card debt. People think they bought time. What they actually bought was a bigger version of the same problem, because the bill always comes back stronger, with interest, fees, stress, and less margin. When the next shock arrives, that delayed debt becomes gasoline on fear. The next thing coming is what makes high earners suddenly feel poor without losing their jobs. The paycheck still arrives. The job title sounds impressive. A strong income can hide a weak system for a very long time. That's why high earners often miss the warning signs first. The money covers the leaks, until it doesn't. The real problem isn't the salary. It's the gap between earnings and resilience. A household making 6 figures can still feel panic if money is committed to oversized rent, luxury SUV payments, daycare, and insurance spikes. High income without margin is just expensive fragility. That's the high-income illusion. Americans mistake visible success for real stability. When pressure rises, those fixed obligations turn into chains. This is why some families making $50,000 feel calmer than families making $150,000. They owe less to the system. Once people realize their lifestyle is fragile, they start protecting the image instead of fixing the math. The next mistake is why Americans defend lifestyles that are quietly making them poorer. It's time to talk about ego and status traps. This is where the math stops mattering. Because now, it's no longer about money. It's about identity. People realize the system is getting tighter, but instead of reducing pressure, they start defending the lifestyle that proves they're still doing well. The moment people feel financially weaker, they often spend harder to look stronger. That's the image trap. Americans protect the neighborhood, the school district, the luxury car, the yearly vacation, the brand-name groceries, the designer gym, and the premium phone upgrade. They protect the appearance of stability, even when the numbers are screaming. Because cutting back feels emotional. It feels like going backward, losing status, admitting weakness, falling behind friends, or becoming less successful. So instead of fixing the system, they protect the image. People rarely go broke from one big mistake. They go broke defending a version of themselves. The lifestyle becomes a costume, and every month the costume gets more expensive to wear. This is why people keep refinancing the car, stretching the mortgage, financing vacations, upgrading phones, and dining out for stress relief. They're buying convenience because they're exhausted, not because they can afford it, because they're trying to preserve the story. And the system loves that, because image spending creates the most profitable kind of customer, the one who can't emotionally downshift. Not everyone reacts to pressure by overspending. Some people do something worse. Nothing. They see the warning signs: shrinking margin, rising balances, tighter cash flow, weaker markets, layoffs in the news, prices moving up again, and they freeze. Most people don't fail because they made the wrong move. They fail because they waited too long to make any move. This is the freeze response. The brain gets overwhelmed by too many threats at once. So instead of acting, it starts negotiating with reality. Maybe next month gets easier. Maybe rates drop. Maybe prices calm down. Maybe work gets better. Maybe bonuses come back. And while the brain is buying hope, the system keeps moving. Bills keep compounding. Debt keeps growing. Savings keep thinning. Waiting feels safe because it delays discomfort. But delay is exactly how the maze wins. This is where layoffs become catastrophic. Not because the layoff caused the weakness, because the weakness was already there. The layoff just removed the illusion. That's why two people can lose the same job and experience totally different outcomes. One already moved early, cut expenses, built cash, reduced debt. The other waited for certainty, and certainty never arrived. When pressure hits, money stops being about status. It becomes time. How many months can you survive if the system turns against you? Wealth is measured in how much time your money can buy your mind. This is runway, not net worth, not car value, not job title, time. How long can you survive a layoff, walk away from a toxic boss, handle a medical surprise, or outlast market fear? That's where the maze loses power, because panic only controls people who have no runway. The system gets loud when your timeline gets short. One family with 6 to 12 months saved and low debt has options. The other may make more, but if every dollar is assigned, they're living on edge. Runway changes behavior. It lets you think slower, negotiate better, and choose instead of react. That's why Rex trusts optionality more than visible wealth. But most Americans accidentally destroy their runway trying to feel safe. Chapter 10. False safety is expensive. This is where smart people quietly sabotage themselves. The moment uncertainty rises, they start buying things that feel like security. A newer car so it won't break. A bigger house to lock in the area. Extra subscriptions for convenience. Bulk shopping runs that go half unused. Premium memberships just in case. It all sounds responsible. That's why it's dangerous. Fear loves purchases that disguise themselves as protection. This is false safety. The spending doesn't reduce risk, it only reduces liquidity. And liquidity is what actually protects you when the system tightens. People say they're preparing, but what they're often doing is converting flexible cash into depreciating stuff. A full garage can make people feel safer than a full savings account. That line hits because it exposes the illusion. The runway got shorter. And now the next real shock becomes harder to absorb. People accidentally trade real safety for emotional comfort. Chapter 11. Speed creates distance. This is the part almost nobody notices until months later. The people who come out ahead are rarely the smartest. Small moves made early create massive distance later. One family waits. They protect habits. They defend lifestyle. They assume the pressure will pass. The other family moves quietly, trims discretionary spending, builds extra cash, attacks high-interest debt, pauses status upgrades, protects investing discipline. At first, the difference looks tiny, almost invisible. Maybe $200 a month. Fewer takeout orders, no new phone, one less trip, lower Amazon drift. But 6 months later, the gap is massive. One family feels trapped. The other has choices. Financial distance is rarely built by giant wins. It's built by early boring decisions. Chapter 12. The Final Truth. What's coming is not just higher prices, not weaker markets, not layoffs. Those are only the visible parts. What's really coming is a separation between the people who let pressure make their decisions and the people who build margin before pressure arrives. Economic shocks don't create weak systems, they reveal them. That's the truth most Americans learn too late. The people who move early will not look dramatic. They'll look boring. But boring wins. They'll protect cash, reduce pressure, keep investing discipline. And when the next real wave hits, they won't panic. They'll already be positioned. The future rarely destroys people. It exposes who was already unprepared. What's the first thing you would cut today if you knew the next shock was already on the way? Tell me in the comments. The next trap on your screen explains why Americans stay broke even on 6 figures. Click to watch.